Across the United States, families are facing impossible choices. High mortgage rates, soaring home prices, and relentless inflation are reshaping what family life looks like. Today, we're going to explore how some families, like one in Cape Canaveral, Florida, are rewriting the rules of home, family, and finances, and how you can avoid getting trapped in a financial corner that limits your choices. Financial stress is not just about numbers. It impacts mental health, relationships, and life decisions. When inflation rises, wages often lag behind, forcing families to reallocate budgets, delay purchases, or take on more debt. Historical analysis shows that during past inflation spikes and recessions, families who lacked contingency planning were most affected. National statistics illustrate this scale. Mortgage rates, which were below 3% during 2020, now hover above 6%. Home prices have increased faster than median incomes in many areas. This creates a financial squeeze, especially for families with children, debt, or fixed incomes. Understanding the psychology of financial stress is critical during this time. Families may avoid selling or refinancing a home because of fear of losing low-interest mortgages, social pressures, or uncertainty about future costs. This lock-in effect presents flexibility and can magnify financial stress. Viewers will gain insight into the compounding effect of high rates and inflation, seeing real-life consequences and learning the tools to regain control. Strategies such as diversifying income, maintaining liquidity, and building emergency funds can help prevent long-term financial damage in times of recession and growing economic fear. We'll also provide actionable steps to plan ahead and protect family wealth so viewers can avoid reactive financial decisions. By understanding economic trends and applying strategic planning, anyone can navigate today's unpredictable market with confidence. A family in Canaveral, Florida, filed their divorce in April of 2025, but their 2% mortgage from 2020 still binds them financially. One family, the husband, lives in the main house. His wife in a 19-foot Airstream trailer on the property. Kids rotate nights between the house and the trailer, coordinated through shared digital notes. Weekly family meals are maintained. This arrangement preserves a low-rate mortgage, which would be prohibitively expensive to refinance today. Neither one of these individuals can afford to go off on their own. So this alternative provides the perfect scenario for them. The concept of nesting is growing across the U.S. As families face high housing costs, family divide living spaces, duplicate essentials, or use portable homes. Examples include multiple families in the same property using separate floors or shared vacation homes split between parents. Nesting is not only a cost-saving measure, but also maintains stability for children. This emotional impact is significant. Parents face privacy challenges, constant coordination, and blurred boundaries, which can affect mental health. Stress management techniques such as scheduled handoffs, clear rules, and defined private spaces can mitigate tension. Counseling or support groups are often beneficial, especially for people seeking separation. Financially preserving a low-rate mortgage saves tens of thousands of dollars annually for the couple. For example, a $265,000 mortgage at 2% versus a 6.5% creates a monthly difference of nearly $1,200, totaling over $14,000 per year. Over a 10-year period, that compounds to over $140,000 in savings, not including potential investments growth on that capital. Viewers can apply these lessons, consider temporary rentals, co-living, or portable housing solutions to maintain cash flow. Evaluate home equity, calculate potential savings versus expensive, and explore refinancing only when financially advantageous. The key takeaway is proactive planning and flexibility. The lock-in effect. Millions of families are sitting on low interest rates from 2020 and cannot afford to move. Nearly 2 million home sales were lost between 2020 and 2024, highlighting the scale of this issue. The inability to move creates a ripple effect in the economy, including reduced home inventory and slower market growth. Inflation compounds pressures. Rising costs of groceries, utilities, healthcare, and gas force families to make hard choices. National averages show that food costs increased over 12% in the past 2 years, gas over 20%, and utilities over 15%. These numbers illustrate why families may struggle to maintain stability. And with mortgage rates rising, this is only more concerning. Mortgage math demonstrates the challenge. As mentioned earlier, a $265 mortgage at 2% equals roughly $1,000 per month, while at 6.5% it raises to $2,200 per month. Over 30 years, the interest difference is nearly $300,000. Families locked in a low-rate mortgage benefit tremendously by staying put. So that's why we're starting to see a decline in home sales. Regional variations exacerbate or evaluate the issue. Cape Canaveral, where this family lives, shows home prices growth above the national average. Other regions, like certain Midwest cities, may have slower appreciation but still present affordability challenges when factoring in income and cost of living ratios. Recession-proof strategies include maintaining high liquidity, diversifying income streams such as having 2 or even 3 jobs in some cases, and investing in low-risk assets. Treasury bonds, money market funds, and dividend-paying stocks are examples of safe investment vehicles that protect your capital. The focus is on creating a buffer against economic shocks and sustaining flexibility during downturns. Emergency funds are critical. Always maintain 6 to 12 months of housing expenses in liquid accounts. If you have a single stream of income, this is especially important to have even closer to 12 months of emergency fund fully funded. This acts as a safety net against job loss, illness, or other unforeseen events. Families without sufficient reserves are often forced into high-interest debt or distressed sales when economic downturns come into their lives. Mortgage selection is another key factor. Choose homes within budget. Consider assumable loans and understand amortization schedules because you want to avoid over-leveraging by calculating sustainable payments that factor in potential rate increases. Detailed examples show how choosing a 15-year versus 30-year loan affects monthly payments and total interest. Legal protections such as co-ownership agreements or diverse settlements help prevent financial traps. Written agreements on buyouts, inheritance, or shared property usage provide clarity and reduce disputes as well. Consulting an attorney can prevent costly conflicts later on. Income diversification strategies include side hustles, rental properties, remote work, or online businesses can supplement primary income. Examples include short-term rentals, e-commerce stores, or freelance work. Multiple income streams reduce reliance on one paycheck and increase resilience. Be sure to track every dollar spent to identify inflation-sensitive costs, reduce discretionary spending without sacrificing quality of life, and negotiate property taxes, insurance premiums, and utility bills. Small monthly adjustments accumulate into significant annual savings because temporary housing solutions include considering co-living arrangements, tiny homes, or accessory dwelling units, or ADUs. These can reduce monthly housing costs while maintaining stability and flexibility. Families like the one I described today demonstrate resilience, but proactive planning allows you to avoid their stress. By implementing recession-proof strategies, diversifying income, and protecting assets, and planning ahead, you can safeguard your finances, family, and future even in challenging economic times. Knowledge, preparation, and flexibility are your most powerful tools for financial security.